Welcome to G2 Weekly Market Update, where we break down the key global market movements and economic developments shaping investor sentiment. This week, markets reacted to the Federal Reserve's final policy decision of the year, shifting expectations around labor market risks, central bank divergence across regions, and persistent valuation concerns tied to artificial intelligence investments. United States. US equity markets moved higher during the week, with several major indexes touching record highs, supported by the Federal Reserve's third consecutive interest rate cut. Small cap stocks outperformed, reflecting increased sensitivity to easing financial conditions, while the Dow also posted solid gains. However, late week volatility saw the S&P 500 give back earlier advances and technology stocks lagged as renewed valuation concerns resurfaced. The Federal Reserve lowered its policy rate by 25 basis points to a range of 3.5% to 3.75%. Though the decision revealed growing internal division, the three policymakers dissenting. Chair Jerome Powell struck a balanced tone, noting that while rates are now near neutral, there are rising downside risks to the labor market that warrant caution. The Fed also signaled readiness to manage liquidity through short-term treasury purchases if needed. Labor market data painted a mixed picture. Weekly jobless claims jumped to the highest level since September, adding to concerns about slowing employment momentum even as job openings urged higher. Treasury markets reflected this uncertainty, with short-term yields declining after the Fed's decision while long-term yields moved higher, signaling diverging views on growth and inflation ahead. Europe. European markets ended the week mixed as investors weighed evolving central bank guidance against slowing growth data. The Stocks Europe 600 edged lower, while Germany and Italy posted modest gains as France and UK finished slightly down. European central bank officials signaled growing comfort with keeping rates steady or potentially hiking if data warrants, citing resilience in growth and inflation risks skewed to the upside. In the UK, economic data disappointed as GDP unexpectedly contracted again in October, with housing market activity cooling amid tax uncertainty and budget concerns. Switzerland's central bank maintained its zero rate policy, citing subdued inflation and weak economic momentum. Japan. Japanese equities advanced, supported by expectations of an imminent Bank of Japan rate hike. Markets increasingly believe that Bank of Japan will raise rates at its December meeting, reflecting improved communication and confidence that inflation is moving sustainably towards the 2% target. Government bond yields rose to near multi-decade highs, while the yen remained relatively stable. Governor Ueda reinforced expectations for further tightening, highlighting wage growth and underlining inflation momentum. Even as Japan's revised third quarter GDP showed a deeper contraction than initially estimated, driven by weaker capital expenditure. China. Chinese equities edged lower as investors took profits following recent gains. Inflation data continued to underscore persistent deflationary pressures, with producer prices remaining deeply negative and consumer inflation subdued. China's economy remains weighed down by a prolonged property sector downturn, dampening consumption and pricing power. Despite government efforts to curb price war and stabilize growth, progress has been limited, reinforcing expectations that China's recovery will remain uneven compared to the other major economies. G2 takeaway. This week highlighted a clear shift towards monetary policy divergence globally, while the US moves closer to a pause amid labor market risks. Europe and Japan face tightening considerations, and China continues to battle deflation. Markets remain supported by liquidity, but valuations, particularly in AI linked sectors, are under increasing scrutiny. That is your G2 weekly market update. Thanks for watching and stay connected with G2 for clear, timely insights into global markets and the forces shaping the investment landscape. Thank you.